Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, the Challenger and the Optimizer go head-to-head on 76% of active fund managers lost to a robot. Stop paying them to underperform. Let's get into it.
Let's cut straight to it. 76% of active fund managers in the UK failed to beat a simple passive tracker over 10 years. You're paying them more to deliver less.
And I don't dispute that number. But what that tracker is actually buying you has changed dramatically. The top 10 stocks in the S&P 500 now make up 39% of the index. You're not diversified, you're concentrated in American tech.
Sure, but concentration risk is a theoretical concern. In practice, those tech companies have delivered extraordinary returns. The passive investor rode that wave for 0.06% a year.
They rode it up, yes. But what happens when it turns? If you'd been passively invested in Japanese equities in 1989, you'd have waited over 30 years to break even.
That's why you buy a global tracker, not a single country fund. And even in specific markets, the data is brutal. In global equities, where most ISA investors actually put their money, only 13% of active managers beat the index. 1 in 8.
Because global equities is the hardest category for active managers. Look at UK smaller companies or emerging markets, the inefficiencies there give skilled managers a genuine edge.
Skilled managers. That's the problem, isn't it? Everyone thinks they can pick the skilled one. It's survivorship bias. The funds that failed just quietly closed and disappeared from the data.
That's a fair point on survivorship, I'll give you that. But it doesn't mean the ones that survived got lucky. Fundsmith has beaten the index for over a decade through genuine stock selection.
Fundsmith is actually my favorite example of why the active argument fails. Terry Smith is brilliant and he's basically the only one. One fund out of thousands doesn't justify an industry charging billions in fees.
It justifies being selective rather than dismissing the entire category. The answer isn't all passive or all active, it's knowing where each one works.
But here's the fee drag nobody talks about. A 1% annual management charge doesn't sound like much, but compounded over 30 years on a £20,000 ISA, it can cost you tens of thousands in lost returns.
Only if the active manager doesn't earn that fee back. And some do, particularly in areas like corporate bonds and smaller companies where markets aren't efficiently priced.
Some do. Most don't. And you have to pick them in advance, not in hindsight. Past performance doesn't predict future results. The FCA makes funds print that for a reason.
No, but process does predict consistency. Managers with clear investment philosophies, low portfolio turnover, and skin in the game tend to outperform over longer periods. That's not luck, that's selection criteria.
And yet the Spiver scorecard shows that even over 15-year periods, the majority still underperform. Your selection criteria would need to be better than what professional fund selectors manage.
Here's what passive purists never address: rebalancing. A passive portfolio drifts with the market. When US tech balloons to 70% of your global tracker, nobody's trimming that back for you.
You can rebalance a passive portfolio yourself for free. Buy a global tracker and a UK gilt fund, rebalance once a year. That's not an argument for paying an active manager 1% annually.
Most retail investors don't rebalance though, do they? They set up a direct debit and never look at it again. At least an active manager is making allocation decisions.
Decisions that, 76% of the time, make things worse. I'd rather have an investor who does nothing than one paying someone to actively destroy value.
That's provocative but misleading. The 76% figure lumps together closet trackers charging active fees with genuinely differentiated managers. The industry has a fee problem, not a concept problem.
I actually agree with you there. Closet trackers are a scandal. But that's an argument for lower fees across the board, which is exactly what passive funds deliver.
Or it's an argument for a core satellite approach. Put 70 to 80% in cheap trackers for market exposure, then allocate 20 to 30% to high-conviction active funds in less efficient markets.
So even in your best case scenario, the majority of someone's portfolio should be passive. We're closer to agreeing than you might think.
We are, actually. I'm not defending the average active fund, I'm defending the principle that some market segments reward active management, and dismissing the entire approach leaves money on the table.
Here's the one argument active managers can never answer though: if I buy a FTSE Global All-Cap tracker at 0.06% a year, I am guaranteed to beat at least half of active managers, net of fees, every single year. Guaranteed. No skill required.
Mathematically true before you account for what's inside that index. When 7 tech stocks are driving returns, that guarantee comes with risks the fee comparison doesn't capture.
My final point is simple: stop paying fund managers to underperform. For the vast majority of investors, a cheap tracker fund will beat most professionals over any meaningful time horizon. The data has been clear on this for 20 years.
And mine is this: passive should be your default, not your entire strategy, because the market you're passively buying is more concentrated and fragile than it's been in a generation, and a small allocation to genuinely skilled active management is insurance worth paying for.
The challenger, the optimizer, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.